Good afternoon, everyone. My name is Emre. I have been in equity research for almost 23 years, and I have been with Iş Invest for about 15 years. So today's the topic of my presentation today is valuation of defense companies and pitfalls in using valuation multiples. So what I will do is first I will talk about the different methods, compare them, and go over the drivers and determinants of multiples, mainly EV/EBITDA and PE multiples. Then I will go over an example, a case. It's a Turkish defense company. So to start with, actually there are two methods we use when valuing defense companies or any other industrial or service company. Discounted cash flow analysis and multiple comparison, as I'm sure you're all familiar with. When you compare the two methods, at most times, multiple comparison, people prefer to use multiples because it's quicker, needs much less information compared to DCF models, which are usually more time consuming and needs more extensive data. And multiples are easier to market and explain to investors, and you get fewer pushbacks from investors. On the other hand, DCF models, you have too many assumptions, and usually you get some pushback from clients regarding the underlying assumptions. And DCF measures intrinsic value of a company. Sometimes it may differ from market valuations, especially at times of extreme market conditions. For example, when there is extreme bullishness in the market or extreme bearish market, usually there is a gap between intrinsic value and market value. But multiples are usually more in tune with the current market conditions. They reflect better the market sentiment. The setback of multiples, the main setback is it may not capture differences in risk, growth, or cash generation potential of companies. So next, if you look at the major drivers of two main multiples, I mean EV/EBITDA and PE multiple. Actually, the main drivers of EV/EBITDA is expected cash flow growth, weighted average cost of capital, and finally the what I call reinvestment. Actually, reinvestment is the cash outflow due to capex and the change in working capital. When you look at the PE ratio, again you have three major drivers. One is expected earnings growth rate, cost of equity, and the dividend payout ratio. Of course, these equations are for constant growth model. I mean, this one is a free cash, discounted free cash equation, assuming a constant growth over the projection period. And this is, as you may see, the dividend discount model. Again, it assumes a stable growth. You can change these equations. You can make, two-stage growth or three-stage growth. I mean, we should also be aware of accounting and tax differences when using multiples. Usually, there may be problems with things like R&D expenses, especially for the defense companies, because some companies, especially US companies, they expense R&D expenses, but according to IFRS, IFRS allows capitalization of R&D expenses. So this is a major difference you should take into account. There are sometimes differences between effective tax rates. So in these cases, PE multiple is a better measure because it takes into account the tax rate and the, as well. This is what we see actually. Some companies, especially in the retail sector, they account for implicit interest for receivables and payables, and they report these numbers below the operating lines, and this may sometimes distort EBITDA multiples. So in these cases, it's good to use PE multiples. For example, retailers does that very often. When you have high inflation, high interest rates, I think Ukraine also is the same problem with Turkey. I mean, your inflation is not bad, but you have high interest rates. So these adjustments are important. Now I want to go over an example so that we can see how the drivers of multiples influence the valuation. This is a Turkish defense company. It's called Aselsan. It's one of the large defense companies in Turkey. It's a government-controlled company. It's specialized for the production of electronic systems and system integration. So basically what they do is, for example, we produce, F-35 plane. What Aselsan does, they do the navigation systems, the, all the electronic equipment, the missile guidance systems. So they do the electronics part of everything, all the military equipment. The market cap is around these are all in dollars, $3.4 billion. The free float is 26%. The company has a very large backlog, $10.2 billion, so $2 billion revenues. So you see that they have a guaranteed 5-year revenue. I mean, when you look at the backlog, it's 5 times the revenues. So what we did is actually we have chosen a peer group consisting of 37 defense companies from Europe, US, and Asia. And we compared the PE and EV/EBITDA multiples of Aselsan with the peer group. We also did a DCF analysis. These are the DCF assumptions: weighted cost of capital, weighted average cost of capital, terminal growth, EBITDA margin, free cash margin, and EBITDA conversion ratio. So maybe before I go to the next slide, maybe I can ask you. What we did actually, we looked at the relationship between EV/EBITDA multiple of the peer group and the drivers I mentioned in the previous slides, which are free cash flow growth, weighted average cost of capital, and reinvestment ratio. Actually, we looked at free cash margin, which is a good proxy for reinvestment, because free cash flow margin takes into account capex and working capital. So I want to ask maybe to audience, what do you think? Which variable you think explains most of the variation in EV/EBITDA multiple, for example? And you look at this, 37 companies. When you plot EV/EBITDA on one axis, and then you plot the other variables like free cash flow growth, free cash flow margin, and weighted average cost of capital. So, for example, what would you say explains most of the variance in the multiple? I mean, among the three. For example, who says weighted average cost of capital is the major driver? I mean, maybe two. How about free cash flow growth? Yeah, more, maybe, yeah, more. And free cash margin?
How do you estimate?
How do you calculate? Free cash margin is actually, we took the numbers from Bloomberg. It's EBITDA minus capex minus change in working capital, and then you get the free cash, and then you divide it to the revenues, you get a margin. So I think a lot of people said growth, because we associate multiples with growth and risk, right? That's the when a company is trading at high multiple, it's either it's growing very fast or the risk is low. That's what the common sense tells us. But when we did this analysis with defense companies, I mean this 37 defense company, we found that the highest cash flow margin has the highest explanatory power among the three. Okay, so when you plot, cash flow margin and EV/EBITDA, I mean this axis is EV/EBITDA, and this is the cash flow margin. So the closest correlation between EV/EBITDA and free cash flow margin. So you see Aselsan on this here on this corner, because it has a negative free cash flow margin, so its EV/EBITDA multiple is much lower compared to the peer group. So the next best explanatory variable was free cash flow growth. So these two explained, relatively well. So here you see the relationship between the EV/EBITDA multiple and free cash flow. So the R square was the next highest. When I looked at the other variables like weighted average cost of capital, and the correlation was not that much. I mean, it seems that these two mattered more for defense companies at least. I mean, the ones that we looked. So similar things, similar relation was with PE ratio and free cash flow margin. So again, for the PE ratio, you would expect ROE or cost of equity or earnings growth to have more influence on the multiple, right? I mean, so in this case also the highest correlation was with free cash flow margin. I mean, for the PE ratio as well. The conclusion is the low EBITDA conversion and free cash margin seems to be the main reasons for the large discount with respect to peer. Because here you have a company which is which has a 5-year guaranteed revenues. So you can say the visibility is very high. It has a very high visibility. And it's a monopoly. It's the only company in this field. So, and then you have these large discounts with respect to the peer group. I mean, you would expect the company to trade at much lower multiples. But the main reason, as we see, I mean, from the earlier graphs, is the EBITDA conversion and the free cash margin seems to be the reasons for this big discount. Okay, and when you look at the details, we see that in Turkey, I mean, the new project awards to the defense companies grown very fast. I mean, in 2016, 17, 18, there was total 24 billion projects awarded to defense companies and defense contracts. And Aselsan had 9 billion share in this total. And when you look at Turkey's defense spending, the defense budget for these 3 years totals $55 billion. So when you think the share of equipment is around 30 to 35% in the total amount awarded, this means Turkey has a 17 billion budget, but the projects awarded was 24 billion. So this creates a cash flow problem for the companies, because it means that the state may be slow to make payments to these companies, because it awarded too much contracts exceeding the budget. So this started creating some problems in the cash generation of Aselsan starting 2019. And looking at these figures, it seems that the problem may continue for a few years, because you have all these projects awarded, you have a limited budget, so payment problems, working capital problems could continue, because these companies work with advances. So they get a contract, and then the government pays in advance, then you start the job, and as you finish and you complete the project, you get the payment. So if the advances are going down, then the working capital requirement increases. So this seems to be the major problem behind the big discount. This is what we think. So what we did is we also try to understand the sensitivity of EV/EBITDA multiple to cash generation. So here what we wanted to do is we wanted to know how much improvement in EBITDA conversion will impact the EV/EBITDA multiple. I mean, what we do is here we take the market multiple, 6. We work backwards and plug in the EBITDA number, the tax rate, depreciation, and EBITDA conversion. Of course, one reason of this, the only reason of the discount is not free cash generation. It's also here you see a high implied weighted average cost of capital. So there are also factors like geopolitical risks, equity risk premium. So these factors also impact a lower EBITDA multiple. So here we work backwards. I mean, this is the market multiple, and these are, you can think of this as an implied weighted average cost of capital, market implied. I mean, not the model, the one that we use in the model. The one that we use in the model, for example, is 10 for the long term. But currently the market implies a higher risk rate. So the things that influence the market is, of course, part of it is due to risk, but a big part of it is coming from EBITDA conversion. So if you improve this number by 5%, if the EBITDA conversion, I mean conversion from EBITDA to cash. So what I do is I deduct the working capital and capex, and then divide it to EBITDA. So if there is a 5% increase in conversion ratio, that means close to 1% improvement in the multiple, according to this simplified, constant growth calculation. When we look at our own projections, EBITDA conversion increases do not increase until 2023. So in our DCF model, it goes up to 45 only in 2023. So maybe one should not expect the multiples to converge to industry averages before 2023. So what I wanted to say today is, okay, the multiples are easy to use, but it's always a good idea to look what's behind the multiples. I mean, what drives the discount with respect to the peers. I mean, before expecting the multiples of the company to converge rapidly to the peer multiples, that doesn't happen most of the times. I mean, So it's good to understand, what are the reasons why there is a, big discount, and when you figure out the reasons, then you can forecast when these parameters will improve in the future, so you can make maybe better predictions regarding the price movements. So maybe the conclusion for this presentation is always mind the gap between discounted cash flows and multiple analysis. So whenever you have you do evaluation, whenever you see a big gap between DCF analysis and what multiples are telling, so it's always helpful to look for the reasons why the gap is there and try to understand it. I mean, before reaching conclusions about it. So in this case, maybe what would be the better method to value the company? Maybe in this case, DCF would be a better way to value the company, because in DCF you can show the improvements in cash flow. I mean, in our model 2023, things get better, and then discounted cash flow analysis reflects that better. So in this example, maybe multiples is not a good way to go. So that concludes my presentation. If you have any questions, we can go over them. Thank you.